Hi everyone, welcome to Investing Counterpoint. Today we're going to run a simulation of Israeli attack on Iran, which is actually happening already. I was going to release this video a couple of days ago, but the model is still the same. It doesn't kind of know about these events. What I want to illustrate here is how risk management really is done. Risk management is done not by forecasting a specific event, but by actually measuring the impact. And we're going to use StressTestAI, which is the newest tool that we've created that mixes the concept, blends the concept of, let's say, risk-aware ChatGPT with a very sophisticated risk model. So here we see a portfolio, a sample portfolio of Bitcoin, gold, Nasdaq, and silver. So I want to see how those assets will react to a conflict in the Middle East, like the one we're seeing. We're only in the very kind of nascent stages of it. And so I'm going to click Custom Stress Test AI. And I'm just going to enter a query. Israel attacks Iran. Now, it used to be that, just a couple years ago, in order to create a scenario like this, you would have to sit there, be very fluent with the risk model, with the multi-factor risk model, pick appropriate factors, do appropriate scaling, and only then are you going to actually create a scenario which would take you days to do. We've changed this with Stress Test AI. You're now able to model it on the fly. Our clients are using it to improve their communication with their clients, right? So you're talking to your clients who are investing money with you. You can now very quickly model a scenario before it occurs, as it's occurring. Here you see that the model itself, the large language model combined with the multi-factor risk model, came up with a scenario where oil is up 2.5 standard deviations, S&P energy is up 2 standard deviations. Overall stock market is down though, and the 10-year curve is up 1.5 standard deviations, so significant increase in the interest rate. Now, we're only in the beginning stages of it. We're seeing, we don't know exactly what's going to happen, but the model seems to suggest that this is the proper scenario, and I can actually click Show Explanation. Notice that it absorbed all kinds of research here. These are links to the research articles, and this is the explanation of each factor that is shocked. Why is the S&P energy factor shocked? Why is the 10-year shocked, for example, because of the political uncertainty in safe haven, and so on and so forth, okay? So we're gonna go ahead and accept this scenario, apply it to our portfolio. And what we're seeing here is that the impact is actually overall positive to this particular scenario. We saw that certain things like oil are up, energy is up, but overall stock market is somewhat down, right? The rates are going down, which is what we're going to see in the 10-year. So we can see here that the gain for this portfolio, which is equal weighted those four assets, is 17.1%. But on the right, we're seeing that Bitcoin, gold, and silver are up in that order of magnitude. So Bitcoin is up the most, gold is second, silver is third, and the one asset that is down in this portfolio is Nasdaq. So according to the multi-factor risk model, in this scenario, if this turns in, it's already a very serious attack. This is what we would expect. Now, looking at the markets just before the video, again, we're in the early stages. We're seeing that the Bitcoin is actually down, but this is not over yet, right? We'll see in a few days where this shakes out. I think it's very plausible that this will happen, and this is based on a factor model that has close to 1,000 factors, has a correlation matrix of these factors, and these correlations are actually tested and derived from extreme periods. So you can sort of rely on this as a rule of thumb that it will be fairly accurate in this particular scenario. Let's try to model a different scenario, the same one, but with adding prolonged hostilities. Because it's very different when you have a transient attack, however serious, or a prolonged war. So I wrote Israel attacks Iran, prolonged hostilities. So now we see a somewhat different scenario. Because it's prolonged, apparently the LLMs decided to shock the emerging market sovereign spread, figuring that if the event is short, there will not be contagion. If the event is longer, there will be contagion. Again, we can look at the explanations here and look at the emerging market sovereign spread. Basically, it says that escalation could lead to increase in risk perception, widening sovereign spreads. Okay, so you can use those explanations when you communicate with clients, or write a blog. I'm going to go ahead and apply this scenario to this portfolio. So now what's interesting is now we get a loss. So if the event is somewhat transient, right, we're not adding the qualifier that it's prolonged hostilities, what we're seeing is that the portfolio is actually up. But if the event is prolonged with contagion, then we're seeing the portfolio is down, with gold and silver actually going up, and Bitcoin and Nasdaq are down. Of course, this, Federal Reserve can come in and change the whole equation, but this is probably because a lot of the price movement, let's say in Bitcoin, is driven by emerging markets. It's true. Gold and silver is also driven by emerging markets, but more by governments. And you would think that in a prolonged scenario like this, they would be buying a lot more gold and silver to increase their reserves of precious metals. So to summarize, we've modeled two types of scenarios related to the Israel attack on Iran. One scenario is where basically a default scenario where portfolios are actually up. And by the way, all this is not to minimize the war or horror of war or the costs of it. It's just to understand the impacts that people will feel in their retirement portfolios and in their lives, right? So Bitcoin, gold, and silver in that order will be up if there's an attack that's transient, right? And if prolonged hostilities, we're going to have a bit of a bifurcation where Bitcoin will suffer quite a bit more than Nasdaq, and gold and silver will go up. So hopefully you find this useful. The idea about risk modeling, again, is not to predict a specific scenario. It's to run a number of scenarios and understand what your portfolio is positioned for. And there's a certain risk in your portfolio where some assets is really exposed to some events, like Bitcoin here. It doesn't mean you have to sell it. All it means is that you have to be highly convinced that it will do well, that there's alpha assigned to it. That's the proper risk and investment management. You run a scenario, you understand what your vulnerabilities are, and then you look at the parts of the portfolio that are particularly vulnerable, and you examine your conviction. Are you really convinced that those things you should be holding? You could do this with any portfolio in any scenario, trade war that we've done before, or major real estate decline. It's also helpful to model specific situations. Let's say you know somebody who's like heavily invested in the hospitality industry. You can go ahead and test the hospitality stress. What happens if, there's hospitality industry crash? So with that, thank you. We'll see you again modeling new scenarios soon. Thank you for watching. Please subscribe and please comment and let us know which scenarios you want to run, whether you agree or disagree with this, and whether it's useful. Thank you. Bye.